The American housing crisis is not being fought with bricks. It is being fought with bonds. This week, Donald Trump announced something extraordinary. He ordered his representatives to buy $200 billion in mortgage bonds, not through the Federal Reserve, but through Fannie Mae and Freddie Mac. The promise sounds simple. Buy the bonds, push rates down, lower monthly payments, make homes affordable again. But here is the uncomfortable truth. Housing costs are not high because one lever was ignored. They are high because the system itself is jammed. 4 million homes short. Millions locked into ultra-low pandemic mortgages. A market frozen in place. So the real question is not whether this move sounds bold. It is whether political power can overpower economic gravity. Stay with me, because this moment is not just about housing. It is about who truly controls America's economy. And to understand that, we need to start with the problem itself. At the center of this story is a misunderstanding many Americans share. We assume mortgage rates rise and fall with one decision: a rate cut, a rate hike, but housing does not work that way. Mortgage rates sit at the intersection of finance, supply, behavior, and trust. They respond to bond markets, not presidential announcements. They reflect risk, not intent. Trump's order targets mortgage-backed securities. The same instruments the Federal Reserve used during the pandemic. Back then, massive purchases helped push rates to historic lows. But the context has changed. Today, homeowners who locked in cheap loans refuse to move. Builders face higher costs and zoning limits. Inventory has collapsed to levels not seen since the aftermath of the financial crisis. Even when the Fed cut rates, mortgages barely moved because the blockage is structural, not monetary. So this is not a question of whether buying bonds can help. It is a question of whether it can fix a system built on scarcity. To see why that scarcity exists, we have to go back. To understand today's housing paralysis, we have to look backward, not to politics, but to structure. After the financial crisis, the United States stopped building. Cautious lenders, tighter regulations, a generation of builders wiped out. Then came a decade of underbuilding. Zoning rules froze supply. Local resistance blocked density. Construction lagged population growth year after year. By the time the pandemic arrived, the system was already fragile. Then rates collapsed, demand exploded, prices surged, millions bought homes at historically low mortgage rates. Those loans became golden handcuffs. Move now and your payment doubles. So people stayed. Inventory vanished. Mobility died. Goldman Sachs estimates America is short nearly 4 million homes. That number is not a cycle. It is a structural gap. This is the world Trump is stepping into, not a normal market, a locked one. And that is why the next shock matters so much. Then came the announcement, sudden, direct, personnel, my representatives, Trump wrote, not the Federal Reserve, not Congress. Two government-backed giants were named instead, Fannie Mae, Freddie Mac. Together, they sit at the heart of America's mortgage system. They buy loans, they bundle risk, they quietly shape what millions pay each month. Trump's claim was bold, that these entities are now worth an absolute fortune, that they hold $200 billion in cash, that this money can be deployed immediately to push rates down. In theory, the logic is familiar. More buyers of mortgage bonds, higher bond prices, lower yields, cheaper mortgages. But this is where theory collides with reality, because Trump did not say how. He did not say when. And he did not say under what legal authority. Markets noticed, so did regulators, and suddenly a housing policy proposal turned into something else entirely. A test of institutional boundaries. And behind that test lies a deeper mechanism few people talk about. What Trump is really challenging here is not mortgage rates. It is the architecture of economic power. In the United States, there is a deliberate separation Politics sets goals. Institutions manage systems. The Federal Reserve controls monetary policy. Fannie Mae and Freddie Mac operate under strict mandates. They are designed to be boring, predictable, technocratic. That separation exists for a reason, because markets run on credibility, not commands. When the Fed bought mortgage bonds during the pandemic, it followed a clear framework, transparent rules, defined limits, an explicit emergency. This is different. Here, a political leader signals intervention without process, without timelines, without legal clarity, and markets react not just to action, but to uncertainty. If investors fear policy can shift by declaration, risk premiums rise, not fall. So the paradox emerges. An effort meant to lower borrowing costs can raise them instead, because housing finance is not moved by force. It is moved by trust in the system behind it. And that trust is fragile. Which brings us to the second shock. The moment this promise meets reality, the second shock arrives quietly, not with an announcement, but with friction. Because even if the bonds are bought, the bottleneck remains. Homes do not appear because yields move. Families do not list houses because policy shifts. The market is frozen by incentives. Sell, and you lose your low rate. Buy, and you face limited supply. So prices stay high, volume stays low, and relief never reaches the people it is meant to help. Meanwhile, legal questions surface. Who authorized the purchase? Under what statute? With what oversight? Uncertainty spreads. Lenders hesitate. Investors demand higher compensation for risk. And the irony deepens. A policy designed to ease pressure begins to create it. Because housing is not just an asset class. It is where financial logic meets human behavior. And behavior does not change on command. Which is why the real impact of this move is not first felt on Wall Street. It is felt at the kitchen table. If you are trying to buy a home right now, this debate feels distant, abstract, institutional, but its consequences land directly on you. You scroll listings that vanish in days. You calculate payments that refuse to come down. You delay decisions because nothing feels stable. This announcement does not unlock your future. It suspends it because what households need most is not a headline. It is certainty, supply, time. Lower rates mean little if there is nothing to buy. Cheaper credit means little if prices stay elevated. And every month this persists, another generation waits. Waits to start families. Waits to build equity. Waits to feel secure. Housing is not just shelter. It is dignity, mobility, belonging. So when policy becomes theater, people absorb the cost. Not investors, not institutions. If this issue matters to you, stay engaged, because the decisions being tested now will shape who gets to own the future. And beyond America's borders, those consequences do not stop. What happens in America's housing market never stays in America. Mortgage bonds are not local instruments. They are global assets held by pension funds, central banks, sovereign investors searching for safety. When political signals interfere with those markets, ripples travel fast. If investors begin to question the independence of U.S. housing finance, they reassess risk. If risk rises, yields rise. And when yields rise in the world's deepest bond market, capital shifts everywhere else. Emerging markets feel it first. Higher dollar yields pull money away. Currencies weaken, borrowing costs climb. All of this from a move aimed at making American homes cheaper. There is also a reputational cost. For decades, U.S. financial institutions have been trusted because they were insulated from politics. Predictable, rule-bound, blur that line, and uncertainty becomes global. Housing policy becomes foreign policy. Domestic intervention becomes international signal. This is the hidden weight of the moment. A reminder that in a connected system, no lever is ever small. And that is why the future matters more than the announcement. The future now branches into three paths. Each one tells us something about how power and markets collide. In the first scenario, the optimistic one, institutions absorb the shock. Clear legal authority is established. Purchases are limited, transparent, and coordinated. Mortgage rates ease slightly, not dramatically, but enough to restore confidence. Housing does not become cheap, but it becomes predictable. And predictability in markets is oxygen. The second scenario is muddled. Announcements continue, execution lags. Legal challenges stall action. Rates fluctuate. Buyers hesitate. Builders wait. The market remains frozen, not collapsing, not healing. The third scenario is the most dangerous. Political pressure escalates. Institutional boundaries erode. Investors demand higher risk premiums. Mortgage rates rise instead of fall. Capital pulls back. Housing affordability worsens. Not because of malice, but because systems react defensively when trust breaks. This is the central lesson. Economic systems are not conquered. They are persuaded, and persuasion requires credibility. Which brings us to the final question. This moment is not really about Donald Trump, or mortgage bonds, or even housing. It is about how modern economies are governed. You can command an institution, but you cannot command confidence. America's housing crisis will not be solved by a single purchase or a single post. It will be solved by rebuilding supply, restoring mobility, and respecting the systems that make markets function. If leaders confuse speed with strength, they risk breaking what still works. If institutions retreat, people pay the price. The question you should ask is not whether this plan succeeds. It is what happens if it fails. Because every intervention teaches markets something about restraint, about limits, about trust. If you want to understand where the economy is heading, keep watching these signals. And if this analysis helped clarify the stakes, share it. Stay curious, and I'll see you in the next one.